Hello everyone, welcome back to this week Technical Insights. Global stock markets were hammered for the second week in a row after Donald Trump announced his worldwide reciprocal tariffs last Wednesday. This has ignited a global trade war with trillions wiped off the market that will likely lead US into a recession. The Dow Jones Industrial Average dropped a massive 2,231 points or 5.5% to 38,314 points on Friday. This is the biggest decline since June of 2020, where we experienced the COVID-19 pandemic. This follows a 1,679-point decline last Thursday and marked the first time that we see a more than 1,500 points drop on back-to-back trading days. The S&P 500 also nosedived 322 points or 5.97% to 5,074 points, and this is the biggest decline for the S&P 500 since the March of 2020. The broad index also lost 4.84% on Thursday and is now more than 17% off its all-time high that we saw recently on the 19th of February. The Nasdaq Composite Index, with majority of the tech companies that trade with China, dropped 5.82% or 962 points to 15,587 points. This followed a 5.97 drop on Thursday and take the index now more than 22% from the 16th December record high, signaling that the Nasdaq has now gone into the bear market territory. The sell-off so far was very far and wide, and with only 14 constituents of the S&P 500 higher on Thursday. All market indices closed at the low of the session, with no signs of a rebound after China retaliated with a similar level of tariff to the US. Only 3 other times since World War II has the S&P 500 suffered a 2-day drawdown of more than 10%. The most recent one came on March 2020 during the COVID-19 panic, and of course the November 2008 global financial crisis, followed by the October 1987 Black Monday crash. For the trading week, the 30 stocks Dow has declined by 7.86%. Broad index S&P 500 dropped by 8.08%, and tech-heavy Nasdaq plunged by 10.02%. China on Friday said that they will impose a 34% levy on all US products, shocking the markets who had hoped that the countries would negotiate with Trump before retaliating. Tech stock led the decline on Friday, with Apple losing 7%, bringing its total loss for the week to 13%. AI chipmaker Nvidia also pulled back 7% on Friday, while Tesla also fell by 10%. These 3 companies have the largest exposure to China and are among the hardest hit from Beijing retaliatory action. Boeing and Caterpillar were also big exporters to China, and both of the companies led the Dow Jones lower by 9% and 6% respectively. In Asia, on top of the 34% tariff that Beijing announced on the US, 16 other US companies were also added to the China export control list, with 11 additional firms being included in the list of unreliable entities. The Chinese Commerce Ministry said that the firms added to the control list undermine China's national sovereignty, security, and development priorities. China also announced export and import restriction, with the country applying control on the rare earth export to US effective last Friday. Hong Kong markets were closed on Friday for the Qingming Festival, so do expect the Hong Kong market to accelerate lower this week. And last Thursday, Hong Kong stock plunged as investors' confidence took a blow from Donald Trump's 34% reciprocal tariff on China. This brings the total US tariffs on imports from China to 54% on top of the existing 20% levy. The Hang Seng Index fell by 1.52% or 352 points on Thursday to close at 22,849 points. The Hang Seng Tech Index lost 2.09% on Thursday or 113 points to finish at 5,313 points. Alibaba Group, which exports technology and consumer goods to the US, closed 5.1% lower, while e-commerce giant JD.com also slumped by 5%. EV maker BYD also fell by 8.7%. For the trading week, the Hang Seng Index fell by 2.46%, while the Hang Seng Tech Index lost 3.5%. Both of these Hong Kong indices has clocked their 4th consecutive losing week in a row and are now ending at a 1-month low. Back to Singapore, our local market also suffered from the global trade war. The index fell by 116 points or 2.95% last Friday to end the week in the red at 3,825 points, extending the global market sell-off following Donald Trump's worldwide tariffs. This is the worst one-day percentage drop that we see in the past 8 months, and also the 5th consecutive trading day of decline. Donald Trump has imposed a baseline 10% tariff on Singapore effective the 5th of April, despite us having a free trade agreement with them. Minister of Trade and Industry Gan Kim Yong said that Singapore will engage US to address the concerns that led to the tariffs. However, he emphasized that the negotiation would be difficult if US does not provide specific details regarding its concern. Singapore retail sales number, which came out on Friday, also declined by 3.6% in February on a year-on-year basis, reversing the 4.7% growth in January. ThaiBev and Jennings Singapore were the only two stocks on the STI that were not hit by the sell-off, finishing flat on Friday. Banking stocks like DBS, UOB, and OCBC were some of the hardest hits on Friday. DBS was the worst performer on the STI index, losing $2.22 or 4.88% to close at $43.30. UOB also lost $1.42 or 3.85% to finish at $35.46, while OCBC dropped 47 cents or 2.75% to end at $16.62. For the trading week, the STI lost a total of 3.69%. This is the first losing week in 3 after we recorded a new all-time high last week at 4,005 points. Year to date, our STI is now only up by just 1%. And being in a risk-off environment now, investors should pivot to stocks with more stable earnings like high dividend paying stocks and real estate investment trusts. Large cap defensive stocks like Singtel, ST Engineering, and Keppel DC REIT are some of the most defensive play that investors should focus on now. So for this week's technical analysis, let's take a look at Singtel. Last Friday, Singtel share price closed lower by 7 cents or 1.94% to finish at $3.53. For the trading week, their share price gained about 10 cents or 2.92%. This is Singtel's third consecutive weekly gains given the tariff turmoil that we are going through right now. From the chart, we noted that Singtel's share price has been on an uptrend since the beginning of the year and hit a multi-year high of $3.64 last Friday. Singtel share price managed to break above this $3.40 level, which is seen as a key resistance level set in last September. We tested this level quite a few times in February and March, as you can see over here, before we get a breakthrough to the multi-year high last Friday. The key support level for Singtel can be seen at the 20 days moving average and the 50 days moving average, now at $3.40 and $3.34 respectively. Key resistance level would be the year-to-date high that we saw at $3.64, with the upper bound of the Bollinger Band now at $3.57. Looking at the indicators, the MACD is now showing a strong uptrend reading, even though there was a slight drop in the uptrend momentum last Friday due to the global sell-off. The latest RSI reading is now at 61. It is still showing healthy upside momentum, even though we tested the 70-point overbought mark last week on Tuesday and Thursday. With the MACD and the RSI indicating that the uptrend momentum is still present in Singtel share price, investors may use the 20 days moving average to accumulate further on Singtel shares. This level being the previous resistance level, as you can see here, may have a change in polarity to further support Singtel share price. Based on 17 analysts covering Singtel in the past 3 months, 11 have a strong buy, 4 have a buy call, and 2 have a hold call. There are no sell recommendations, and the average 12-month target price is $3.84, representing a potential upside of 8.74% from last Friday closing price at $3.53. And these are the updates that I have for you this week. If you find the information useful, do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insights.